As I noted on Monday, today I was planning to give a brief synopsis of both the pre and post-Brexit world. Only last week it would appear that the basic macro backdrop of slow but continuing economic growth was on track. In the US, the latest initial unemployment claims had actually declined to a 43-year low and has been below the threshold associated with a strong job market for 68 weeks, the longest streak since 1973. Job openings are in fact at a record high in the US. In addition, sales of existing homes rose to their highest level in 9 years, and on Thursday, the US regulator released the results of their latest bank stress tests, highlighting that bank balance sheets had never been stronger. According to the regulators, the US banking system has the financial strength to withstand an economic meltdown and negative US interest rates. Each of the 33 banks tested survived the toughest test designed by the regulator. Under the simulation, which lasts for 9 quarters, stock prices drop about 50%, unemployment reaches 10%, and gross domestic product declines sharply. What this would mean is that US banks could again increase the effective dividends to shareholders, both in absolute dollars and as a percentage share of profits. The dividend story was well and truly playing out, as noted in these slides. Now, the same story with a lag was emerging in Europe, and European bank stocks were selling at 2 standard deviations below their historic relative lows. Underlying fundamental themes were playing out, and price action was reflecting a closing of relative valuation gaps between economically sensitive sectors, such as banks, and the defensives, which are at their highs. In fact, on Thursday night, post the release of the US bank tests, futures were indicated higher and bank stocks were bid up in post-market trading. And immediately post-closing of the polls, prior to the initial results being announced, bookmakers were reflecting a 90% probability of Remain. Even UKIP leader Nigel Farage was relatively downbeat in his televised TV comments at about midnight UK time. Financial markets, including ourselves, had made the mistake of assuming a logical outcome, and the evidence appeared to support that. Then came probably the most dramatic turnaround in financial markets I've ever witnessed, and we all know what has since transpired. It would appear that a protest vote had gone wrong, and as Google's search analytics suggested, many of those who did vote to leave had actually no idea what they were voting for. In fact, I suspect if there was a second referendum this weekend, we would have a different result. As I've noted before, just when you think you've seen everything, something new comes along. So post-Brexit, there's no point in repeating what is well covered in the media. The obvious is well known. Unlike normal macroeconomic events that cause investors to wax and wane on future growth, Brexit is a political issue that markets believe will create enormous uncertainty and may set off the end of the European Union and/or the end of the United Kingdom if Scotland and Northern Ireland vote for independence. So the fear is years of political uncertainty and thus economic uncertainty. Long term, I doubt it will make a lot of difference. There is no reason for countries not to continue to trade relatively freely with each other. Only politics can genuinely interfere with that, and it will come down to if they want to act with retribution as opposed to a rational resolution of administrative issues. If it actually forces Europe to genuinely integrate and reform, it could actually be a big positive. But short term, there will be enormous uncertainty and markets will be very wary and liable to excessive discounting of business fundamentals. Earnings, real and perceived, will be the key driver of short-term price action. European banks are clearly the most impacted due to fears of recession and thus a bad debt cycle, as well as issues related to dealing with the legalities of the new order. This has had a significant short-term impact on our global portfolio due to our investments in a number of domestic European banking stocks, which we own for the evolving long-term dividend story. Due to the chaos created by a situation where it appears nobody, including the Leave campaigners, were actually expecting a Leave result, markets have been savage in their discounting of short-term fear. Short-term, bank earnings will no doubt be negatively impacted by even lower interest rates in the UK and lower loan growth. Ultimately, the stock price impact will be a function of future earnings and dividend levels, and from that perspective the reaction does look excessive. Short term, it will take time for markets to truly assess the long-term impact, and the key is not to jump to any irrational short-term conclusions. Economic uncertainty, and thus growth, will be impacted, but one should also note that first, the depreciation of the pound will ultimately be a positive stimulus for the UK economy, and second, the balance sheets of banks such as Lloyds, Bank of Ireland and ING are dramatically stronger than they were some 5 years ago. One should also note that European banks are selling at a discount to book, which theoretically suggests they should be wound up, and an indication that valuations may be excessively discounted. The overall situation is very different to previous growth scares, as it is a political event as opposed to normal economic cycle issues playing out. So one does have to think through the issues, but again, the real trick, as we often note, is to make sure one is looking forward and assessing current dynamics as opposed to reacting and making decisions based on what has happened, not what will happen. One of the key issues will be if governments and regulators finally realise that if they wish to sustain economic growth, they now need to focus on fiscally driven capital works. This is particularly so for the Europeans. As noted by the head of the European Central Bank, Mario Draghi, central banks would achieve goals quicker if there was help from fiscal and structural policies. So in summary, the short-term impact of Brexit is obviously an outcome we did not expect or welcome. Our focus is on assessing if underlying fundamental themes have changed and thus warrant changes in our portfolio and/or different opportunities. Short-term, uncertainty is obviously high and the political scene is quite chaotic. Many will question if the UK has shot themselves in the foot and the European Union is at the beginning of the end. Personally, I believe the chaos has been overly discounted, but will obviously take time to resolve. The uncertainty will be longest in duration in Europe and the UK, and it is likely that the US will soon switch its attention towards June quarter earnings results. From the perspective of Australia and Asia, I suspect the impact will be minor. That brings us to the end of our brief update. We will give further updates in our June quarterly video and our reports in mid-July. Thank you very much for your time.